All right, folks. Thanks for joining us today. Hope you guys are all doing well. We've got an interesting market situation at the moment here. But what we're going to talk about today is what I call Trading 101. And it's stocks and option setups for maximum profits. What does that mean? Well, I've got a little story I would like to share with you guys before we get into this. As a quick side note, I think it's really important that you only trade and invest with discretionary capital. What we do in my world is a much more realistic way of looking at the markets. It's nothing hectic. It's I call it active investing. You could call it trading. I think trading sometimes it usually has sort of a bad rap as it relates to day trading. But let's have a look at what we have to say here today. So this is a really interesting story. I held a recent mentoring workshop in New York in, let's say, I think it was March of this year. And the mentoring workshop was really meant for a bunch of rather advanced investment professionals. And they were basically traders or money managers for what's called a family office, which essentially managed the money for one wealthy family. They were from multiple different offices. And what I did is I gave them a quiz. And to my great surprise, I actually still today, when I think about it, I can't really even really get my head around it. I just realized that most of them never really got any training on what I consider to be trading fundamentals, not fundamental analysis, but trading fundamentals. And I found out that many of them knew very little about a lot of things, but really not enough to be dangerous certainly not when trading their own money, and absolutely not for managing other people's money as they were doing or are doing. So what I found is that there's a lot of different holes in the strategies that they supposedly had. And so out of that session came this idea that I need to do a presentation that teaches people about the basics, the real core things that I think are unbelievably important for making money in the markets. Furthermore, what I noticed was that most of these traders, and again, this was an advanced bunch, they didn't really know what to focus on, even though they had a sort of guidelines given them by the companies that they were working for. They didn't really have a process or a plan. And you guys can ask yourself this right now. It's sort of a rhetorical question. Do you really have a process? Is there a process in place that you have that you can trust? And do you have a process to begin with? And what I found out is that most people don't really know what the most important pieces of the market are, the things they need to focus on, and then ultimately how to really break this down into a strategy where they can start putting on trades. And so out of this advanced course that I gave, I pulled out the core things that a trader must understand to make money. And that's what I'm going to show you guys today. So this is really exciting. Just real quick on the agenda, I'm going to have a very organized presentation for you guys now for the next 40 minutes or so. What we're going to do, we're going to talk about the 5 stock market misconceptions. Then we'll talk about what's called the True Trader's Checklist, or what I named the True Trader's Checklist. We'll talk about the trading plan step by step, which includes a bunch of different factors. And ultimately, we'll do some live market scanning and we'll do Q&A. So if you guys have questions, I would really appreciate it if you could wait until I get to the point of the Q&A, just so we can move through this in a very nicely organized fashion. Well, we all know this guy. This gentleman here is Michael Jordan, and he had a lot of really good quotes. And one of the things he once said was that when you get away from fundamentals, the bottom can really fall out of your game, whether that's your basketball game or schoolwork or your job or whatever you're doing. In other words, you can practice shooting the basketball for 8 hours a day, but if your technique is bad, then all you become is very good at shooting the basketball the wrong way. So what we need to do, and this very much applies to trading and investing and anything else worth getting good at in life, whether that's your job or golfing or cooking, you got to get the fundamentals straight. And if you get the fundamentals down, then everything of what you do the level of everything you do is going to rise. And that's what we need to get down. A lot of people know a little about a lot of different things, but they don't really know enough to make money in the market. And that's why they end up losing money. So what are the 5 stock market misconceptions? I'm going to quickly list them for you guys here, and we're going to walk through them now in the next few slides one by one. But these are quite important misconceptions that I think we need to first clear up before we dig into the important things that one needs to know for trading and investing. Well, myth number 1 is that trading equals gambling. And I can tell you that a lot of the hectic day trading stuff that people do, particularly as it relates to markets that are more levered like currencies and commodities, there certainly is an element of gambling in there considering the frequency of trades that one can do. But the reality is that investing in trading isn't really gambling if you do it the right way. So the casino really always has the odds in their favor. The US stock market, however, on average rises about 8 to 10% per annum. Now that's an average number, of course. That's not just any given year. There will be mean reversion years when that is going to be when you can have a down year, but on average that's the return. So in the US stock market, the odds really are in your favor, but you have to let them be in your favor. That's what a lot of people don't do. They actually fight this, and they end up not giving the market the chance that it really has to be given to make them money. Myth number 2 is that a buy and hold strategy beats all other strategies. I'm sure a lot of you guys have probably heard this before. So let's have a look. Well, I think a simple buy the dip and sell the rip, or buy the dip and sell the rally strategy actually dramatically outperforms a simple buy and hold strategy. Now, let me just give you a very simple example here. What we're looking at here is the S&P 500, and we're looking at it through a lens of about the past 15 or so years, or actually a little bit more, actually the past 17 years. And you can see here we had a period from the peak in the year 2000 all the way over to 2013, when the market essentially went sideways, as you can see, which is what we at the time referred to as a secular bear market. Now, if you would have bought stock at some point in the year 2000, somewhere towards the end of it, or I guess the beginning, I forgot it was, I guess it was the beginning of it, anywhere up in here in the top sort of quarter of this range here, and you would have held on to it, you wouldn't have actually really made money until we started breaking out 13 years later, right? So that's not really a very good way of making money in the markets. But if you would have drawn just a couple of, literally, I'm talking about 4 simple lines over the course of 13 years of trading, you can see that if you would have just sold part of your core holdings in, say, the S&P 500, or just part of your core equity holdings, once we started breaking below this first support line here, and then you would have rebought it once we started breaking above this area here, and then sold part of it again here and bought it again coming out of the financial crisis, you would have made, not only would you have made a ton more money than the person who bought, or who owned and held on to their long-term stuff for 13 years and didn't make a dime, but you would have probably also had one of the better performing portfolios compared to any hedge fund. So the stuff here, the key is simplicity, and a lot of people don't have that perspective to keep things simple because they don't have a process. And that's what I'm going to teach you guys today. As a quick side note, because the stock market doesn't move in a linear fashion, your stock market returns are also not going to be linear. So anyone that promises you that you can make exactly $500 a day, or $500 a week, or $500 a month, they have no experience, either that or they're really just telling you a lie. That's not possible, because the market's going to do what it wants to do. Can you make consistent money through the lens of a quarter or a 6-month time frame? Absolutely, you can certainly make money over those kind of time periods. But in the very near term, I think anything else is very unrealistic. So the investment returns are not going to be linear, and that's really, really important to understand, because if you expect a linear return, you most likely are going to have a very difficult time making money in the market. Myth number 3 is an important one, and a lot of people think it takes a lot of money to make money in the market. I don't think it does. I think you don't need a large trading account. Good returns, which what I would classify as 15% per annum, can be achieved really with any account size. So technology has gotten much, much better over the years we have now really gotten technology to a point where it's leveled the playing field for retail investors. They now have access to great investing and trading technology. In fact, some of it that I've seen is actually even better than what I'm seeing on the institutional side. So there's a lot of good news there. Low-cost exchange-traded funds like options and options and derivatives really have given retail investors an edge as well. And actually, institutional investors oftentimes have restrictions in terms of their trading mandates and their investing mandates that the retail trader at home really doesn't have. And if we take that liberty and use it to our advantage, then we can really have a great leg up even on the institutional investors in the world. Myth number 4 is that it requires making money in the market, requires you to be sitting in front of your computer all day. Well, and if any of you guys are familiar with me, you know that's one of my biggest things. I really make sure people don't spend too much time in front of the computer looking at the market. I don't believe in a day trading approach as a fundamental way of making money, because if you got to be strategic in your investing and trading. There's not a single professional hedge fund or a single series investor that I know that makes their money over time with a day trading approach. Can you have a day trading overlay? Can you do a day trade here and there? Yes, of course. But if you spend too much time looking at the flickering ticks, not only is it going to drive you nuts, which we don't want, life actually happens elsewhere, not in front of your computer, but also you're going to lose perspective, and that's really the big thing. And if there's one thing you're going to take away from this presentation, it is my hope that you learn that you got to be patient in the market and gain perspective. So money really isn't made by hectic and random trading. You're going to make you money over time by waiting. What does that mean? That doesn't mean you have to hold something for 13 years, of course not, but you got to be tactical and constantly gain perspective. And I'm going to show you guys some really good ideas here in just a minute. You got to then be able to pounce on those opportunities as they arise, but don't jump the gun on premature opportunities. And the propensity for you to jump prematurely on things is much higher if you don't if you look at the computer the whole day. In other words, you got to be able to eliminate that noise. The more time you start staring at the market, the less good that is for your profits. In other words, you're probably going to lose money over time. Day trading, I think, often leads to emotional distress, and again, that entire focus on the minute-by-minute thing is going to basically close your mind to other opportunities in the market. And as soon as you stop being open-minded about multiple or different outcomes in the stock market, it is pretty much a downward spiral from there. So the best traders and investors really primarily try to gain perspective. And to gain perspective means that you have to be able to take a step back from the stock market and have a much more reasonable approach to it than what's a lot of people try to pitch out there. Myth number 5 is that the stock market is rigged. I don't think the stock market is rigged. I think there's plenty of governing bodies out there that try to level the playing field. In the U.S., we have the SEC. Some advantages are certainly be had by money managers in terms of access to timely information, but for the most part, I don't think any of that should be something that should dissuade you from reaching your investment goals. So I don't think the stock market is rigged as such. Okay, so where are we on our agenda? We just went through the 5 stock market misconceptions. Let's talk about the true trader's checklist. First of all, what is that? Well, when it comes to having a checklist, it's probably one of the major things that I've learned that people don't have. And just before, when I told you the story about those people, was really they're advanced investors that I taught, the family office managers in New York in March. I was just amazed that they didn't really have a process in place. They didn't have something they could hang a hat onto and that they can trust. And so the process and the approach I'm going to show you guys today for the remainder of the presentation is what I call a top-down approach. And it's not a top-down approach in terms of looking at economic fundamentals and things like that, but it's looking at a market environment first and foremost, broadly speaking. Then you dig down into your sectors and groups. Then you look at your instrument and strategy selection, time frame selection. Are there any events that could derail your thesis throughout the holding period? And ultimately, of course, you have to do your reward to risk calculation and order execution. So that's a very simple 7-step list that I see most people don't have. Honestly, even professional investors, a lot of them don't have that. It blows my mind, but it's just how it is. So what I want to make sure is that we get you guys on the right foot for this. So what kind of stocks should you trade? Just as a quick FYI, I'm a big believer in making sure that we trade very liquid things, very liquid stocks, ETFs works as well. So very large liquid stocks like your Tesla and Apple. Even you can trade mid-cap stocks. That certainly works as well. Options as well are very liquid on a lot of these big names. So there's plenty of names, including the ETFs. As long as they're liquid, I think that's the most important thing. Also, make sure you understand the stocks that you trade or invest in. I do think that's important for the most part. And I would avoid stocks trading below $5 because they can be much more easily manipulated. All right, so let's start moving into our trading plan, okay? And just as a quick recap, here is the 7-step checklist for traders that I think is really important. You guys maybe want to take a picture of this with your phone or your iPad, or maybe make a mental note or just write it down with a pen. So let's talk about our 7-step process. Well, number one is the market environment. And you got to make sure you understand where we are, broadly speaking. So let's just give you an example recently of something I did in biotechnology stocks and how I came to that trade. And I'm going to show you guys a couple other trades in just a minute. But you got to have an understanding where we are. Are we in a secular or cyclical bull market? Where are we? Like right now, for example, we're both in a secular bull market, which is like the big picture 15-year stuff, and then we're also in a cyclical bull market. We're very long in the tooth in a cyclical bull market, but we're still in a cyclical bull market. And what are interest rates doing? Well, interest rates right now are marginally rising. I think 4 of the 5 global central banks, large central banks, are looking at talking more hawkishly. Volatility is very, very low. So that's our general environment right now. Well, in that kind of environment, what we want to look for next is sectors and groups. The stock market, the S&P 500, for example, is broken down into about 10 sectors. I think it may be even a little bit more now. They've added 1 or 2, but about 10 sectors, roughly speaking, is kind of what we're looking at. And what you want to look for here are rotation trends, or money flowing into different kinds of different or new in and out of different sectors and groups. Which sectors are leading, which sectors are lagging, are there any breakouts or any breakdowns? That's the kind of stuff you want to look at. So let me show you guys what I saw. So I've got this nifty little scanning tool that I use, and actually let me say one more thing. Here's something really important, and this may be the most important thing for you guys to note. 80% of your money in the stock market is going to be made as a function of your portfolio allocation. So whether you choose to invest in technology stocks as opposed to investing in healthcare stocks, or whether you choose to invest in stocks as opposed to bonds, that's going to basically explain the vast majority of your returns. Much less important is whether you buy Amazon or Facebook or JP Morgan or Bank of America, that kind of thing, right? So this is something a lot of people miss, and that's why a lot of people overtrade and actually end up losing money on a very consistent basis and ultimately give up and blow up their accounts. And so what we're trying to do, we're trying to gain perspective at any given point by understanding this thing. So asset allocation is really by far the most important thing. So what I do is I've got what I call my Steady Trader stock market scanner. And what I use with this is I've, over my nearly 20-year career, devised a way that I measure near-term trends, intermediate-term trends, and longer-term trends. And it's an amalgamation of different things. But I've got it's essentially a spreadsheet like this, but I'm going to show you guys the real-time scanners in just a minute, and I look at those things and I look for changes, right? So you can see here the sectors of the S&P 500 are broken down into near-term bullish sectors, near-term bearish sectors, intermediate-term bullish sectors, intermediate-term bearish sectors, and the same thing for the long term. And then the same thing for the S&P 100 stocks, and we can apply this for really any asset class and any series of stocks. So what we noted in the period of May is that what happened, we started to see on the stock scanner that we have, we started to note that the healthcare stocks started to turn near-term bullish, okay? And I'm going to show you guys this with this real-time example. And so the healthcare stocks turned near-term bullish. You can see they're now near-term bullish. Still, they're also, that's the XLV ETF. Well, the XLV ETF is also medium-term bullish. That's in here. You can see them here. And long-term bullish, the XLV is as well. So, but what happened in March is that after a bit, in May, after a bit of a consolidation period, what happened is the XLV, or the healthcare stocks, started to turn near-term bullish one of the last few days of the month of May. Well, we then dug a little deeper, okay, and that's our next step. We started digging a little deeper, and we figured out that, of course, in healthcare, you have something called biotechnology stocks. So we started digging deeper, and we noticed that the biotech stocks actually on June the 1st, for the very first day of June, started giving us what we call a bullish reversal. And it was all due to the fact that we noticed that the healthcare stocks started showing up at the previous day or maybe 2 days before, started showing up on our near-term bullish scanner list. And so as a result of that, we started looking at biotechnology stocks, the IBB, and we started buying some right here, okay, based upon a bullish reversal here on the 1st of June. And then we bought more on the next sort of leg breakout higher here. I guess it was the 16th or something, 16th of June or something like that, just about here, okay? And it's not because we were doing fundamental analysis or because we were listening to someone on CNBC or because someone sent us a funny email about their latest and greatest stock pick. It's because we saw what was happening in the sectors. It was just very simply the healthcare stocks started to turn near-term bullish within the context of being an immediate term and long-term bullish already. And then we noticed that, yes, we could have bought healthcare stocks. You could have bought the XLVE or some stock within there. But we noticed that biotech stocks really, because they have more alpha, we started going and looking at those. And ultimately, that also led us to stocks like Celgene, and we bought that stock. We bought stock, and I still own it in full disclosure, a stock like Amgen. Right around the same time, we started buying those kind of stocks. And so it all happened because we looked had this sort of top-down approach. Does that make sense so far, guys? Just for a quick FYI, I'd love just a little bit of feedback to make sure, and then we'll definitely take all your questions a little bit in just a few minutes. But so once you've chosen your instrument, in this case, we actually ended up buying some IBB ETF, which is just representing the healthcare space, or excuse me, the biotechnology stocks. Again, based on our sector and group rotation thing, then we needed to determine what's our time frame, okay? And well, we looked at it and we said, listen, you know what? Considering the fact that biotech remains very much range bound, let's make this a near-term trade for right now, because we really just turned bullish near term. So we bought some call spreads and we bought some stock, and really we had an upside price target of $300, our first upside price target, which ended up being reached a couple of weeks later. So what is the time frame is a really important question you have to ask. Can you trade options? Is a very important question. Are there strikes that are pertinent to the time frames and the stock price you're looking at? Is the implied volatility high or low? These are all important questions. And for our biotech IBB that we bought, the implied volatility was very low. The strikes were good. There was a lot of liquidity, so there was really no issue with all that. So you get, again, you can see we're going from a top-down approach and understanding where the money is flowing. Now, the next thing you also need to understand is what kind of trade actually is this? Is it a trend following trade? Is it a breakout trade or a mean reversion trade or something else? Well, in this case, this really was just a mean reversion trade initially. We just bought the biotech name because we wanted it to go and kind of mean revert back to the upper end of the range. But ultimately, once we started seeing this move here and we bought more of the IBB than for a trade, we had a breakout trade. So you got to make sure at any given point you understand what the kind of trade is that you're actually putting on. Time frame, we already talked about it. Again, what's important here is to understand what kind of trade is it, and then build the right time frame around it. Usually, we like to start with a more near-term time frame, and then build that into a more intermediate or longer-term thesis, even if things act well. And what's important here also to understand is that you need to be aware of what the events are. So in the case of biotech stocks, you want to certainly be aware if there's any event risk out there, and you wouldn't believe how few people actually do this. A lot of people will buy a stock and they may be aware that earnings season's coming up, but they're not really aware of anything else. So particularly in something like biotech, you want to be aware if there's like major drug announcements or this or that or FDA approvals or whatever and that kind of stuff, which is one of the reasons why we in this case bought an ETF as opposed to a single name stock, right? But again, we wouldn't have come to this unless we were aware that this was a broader rotation moving back into healthcare, okay, that was taking place. So it wasn't just biotechs randomly bouncing, there was a real move taking place, and we saw that from our near-term bullish, near-term, medium-term, and long-term bullish and bearish scanner that we have here, which again also obviously scans other parts of the market like the S&P 100. You can see exactly what's near-term bullish, near-term bearish, medium-term bullish, medium bearish, and the same thing for the long term. Okay, so we knew at the time when we bought this, there was really no event risk out there, broadly speaking, for biotech, certainly not in terms of earnings. Earnings are coming up now next week, so right now we're looking at closing a lot of the biotech stuff and then looking to maybe rebuy that stuff if we get a chance after earnings. So that's step number 5, is events, and you got to make sure you know when these events are. Some of the events, if you're going to buy an index, maybe the S&P 500 or something like that, or if you buy a single name stock, it may be economic data. If you trade other parts, other kind of asset classes like a currency, maybe you need to be aware of global economic data points. Again, earnings reports, product launch. These are kind of things you need to know and make sure you are aware of every time you buy a stock. And again, you wouldn't believe how few people do this. It's not a lot of work, but it's just a 7-step process, and you wouldn't believe how quickly that becomes second nature if you just do it right. A reward to risk calculation is also something very good to do. I think it's important to understand that what the reward to risk is. So for example, let's say you have a stock you're looking at and it's trading at $50, and let's say you think it goes towards $60. You have a stop loss at 45. Well, that gives us a reward to risk ratio of about 2 to 1. So like for example, in the case of our IBB trade, we bought it somewhere around $290 at the first time, and we targeted $300. So that's about $10 on the upside, and we were looking to risk just about $5 or $6. So there too, you have about a 2 to 1 reward to risk ratio. Again, and it's not so much exactly important what is the reward to risk ratio as much as understanding what it is, so you make sure you understand and you have the risk in mind when you get in and out of a trade. Order execution too is very important. So in the case of our trade in IBB, obviously this is a very liquid instrument where we could just take a market order. It wasn't really that important if we would have traded, or for the options trade, certainly we would have put in a limit order. So it's really important. A limit order basically tells you can tell the market that you don't want to buy a stock above a certain price, for example, right? And so that's the kind of stuff that you need to make sure as well that you plan before you get into the trade, because if you don't do it before you get into the trade, a lot of times you'll be winging it, and that's not what you want. At the same time also, before you get out of the trade or before you get into the trade, you want to make sure you set a very clear stops and also a profit taking order. So in our case, we had a profit target that we placed at $300, which was reached, at least with part of the position, and we had a stop loss, I think somewhere near $285 or something like that. I can't exactly remember, as a worst case stop loss. So we had both of those orders already in there, so we didn't have to really worry about it too much. Again, the objective here is not to be hectically trading the market. It's about being an active investor, for the lack of a better term, and so that's really the way we do it. So let me show you guys a couple more examples here in just a minute. So in review, just a quick pause here. You need to be able to have a process you can stick to, and the way we do that is we narrow into the market from a top to bottom approach. We first look at the broader market, and we look at what the individual sectors are doing, what the groups are doing, then what are the single name stocks doing, and ultimately, if you want to, you can choose options to trade. This process is going to keep you from fighting the market, and it's going to get you into a straightforward, regular, and repeatable process. The worst thing you can do is become a hectic trader that looks at the market the whole day, because what's going to happen is you're gonna lose your perspective. And this approach is very steady. It's very repeatable, whether you have a part-time job, a full-time job, or you are retired or semi-retired. This is an approach that you can actually fit into your lifestyle. A lot of the other stuff, a lot of people try to look at tell you have to look at the stock market the whole day, or 2 in the morning trading this and that. And that's a very, very difficult way of making money, because you never have the perspective needed to actually be able to stay in a trade and to make money on a consistent basis. So let's walk through this one more time, and I want to show you guys the 7-step process. So for example, here is a trade we just did, and I just closed it literally. I'm in Europe right now, and this is a text alert I just sent out that it's now this was 40 minutes ago, something like that. This was like 10:20 a.m. East Coast time, and I just sent out this text alert. I told people that I closed a trade I did in, oh gosh, I didn't even write the ticker. Anyway, the ticker was First Solar. Excuse me, I'll show you guys in just a minute. Anyway, the people know. So it's First Solar. I'm going to show you guys quickly how we got to that trade, just so you guys see again what the process was and how we did it. So here's First Solar, and if you look at one thing here, this is the market scanner that is actually a little bit different today. I took this picture before the open this morning, and one thing that happened is actually energy stocks. The energy sector has now gone near-term bullish for the first time in a long time. But what we started to see more and more energy-related stocks pop up on our near-term bullish list over the past few weeks, and that led us to find, and we also started to see that the energy sector actually disappeared off the short-term bearish list last week, and it turned short-term neutral, and now today it's actually turning short-term bullish. But what we saw because of that, it led us to some of the energy stocks, and some of the solar stocks. And First Solar is a stock that we saw starting to act very well over the past while, but then we actually ended up buying it here on the 11th of July. And we sent in a real-time text alert on that as well. And again, it's because we have the context, not because we were just randomly, clicking around the market and finding random opportunities, but because we have the context needed to buy the stock. So we bought it on the 11th, and we bought some call spreads as well for those of you guys that trade options. And I just sold it. I just showed you guys the text alert here that we did. We sold it for I think a 30% profit in the options, and we also actually had some stocks as well. So it was all not because we were just randomly fumbling around the market, but because we were having a process in place that led us to the opportunities in the market. Financials, for example, the XLF ETF, they're now near-term neutral. And they actually had turned near-term bullish a while back after having been and continuing to be medium-term bullish and long-term bullish, and they gave us an opportunity to buy those a number of weeks ago as well. So what I would like to tell you guys is to get you summer learning on, and what that means is I would like to offer you guys our Market Mastery course and these scanners that are platform neutral. They reside on my website, where they're updated 3 times a week. So what you're going to get access to is an extensive video series and the market scanner lists that allow you to quickly find opportunities in any time frame. You're also going to get access to our live scanning sessions, which we actually do through the month of September. We've had, I think, 1 session so far, so there's still tons more we're going to do. We're going to have them every other week, where we're going to walk you guys through this process, this top-down process. We're going to show you 15 ideas in 30 minutes over through the rest of the summer and through the month of September, so you guys can learn this top-down approach. It's just $197, one-time fee. That's it. You'll have lifetime access to the video series that's going to teach you this approach, and you have lifetime access to the market scanners. Again, the market scanners look like this. We update them 3 times a week on the website, so you don't need a specific platform for this. You'll know exactly over time which sectors are turning near-term bullish, near-term bearish, medium-term bullish, medium-term bearish, and same thing for the S&P 100 stocks. And we're going to start expanding this to other parts of the market real soon as well. So all you have to do is go to, let me quickly type this in here, studytrader.com/grow, and oh, I didn't think I typed that in correctly. Let's see here. All right. If you go to that link I just typed in, it's the one down here, you'll get access to that. We have 25 available at this price, which usually go pretty quickly, so I would probably urge you to take that opportunity here rather sooner rather than later. What you'll learn in the course and in the summer camp is the three-step process to quickly determine the market environment and notice when it changes. You'll learn when to trade stocks or an option or an ETF. A lot of people don't know when they have an opportunity, like I showed you guys in the IBB, for example, before. They don't know when or whether they should trade the stock or the ETF, or they should trade an option. And so that's one thing that you'll definitely learn in this course very quickly. You'll learn how to properly set up your charts and position sizing, key technical patterns, and when and how to trade them. Here are some of the major topics that are included in the course. And again, this is stuff also that this is an evergreen course, okay, including the summer bootcamp, which is real live sessions through the month of September. And all of this is just $197, including the scanners, which I'll talk to you about more in just a second. You can go to thestudytrader.com/go. And again, what we're doing is we're teaching you a process that's reasonable, that you can fit into your existing lifestyle, that return very nice profits because you're not fighting the market. The vast majority part of the reason why people lose money, aside from the fact that they look at the market too much and they stare at the flickering ticks because they have no perspective, is that they fight the market. And the scanners will constantly tell you what is bullish, what is bearish in all three time frames: near term, medium term, and long term. And you'll see, like, for example, this is, again, this one was taken yesterday. We actually today have energy now finally having turned into near-term bullish after having been near-term bearish for a long time. And that is really good perspective to have. And again, and by the way, we're taking questions right now. If you guys have questions, we'll definitely take them right now for you guys. Someone's asking if they don't have a, saying that they don't have a, they don't have a process, and they usually don't know which stocks to trade. And that's exactly what this is for. So if you guys have any questions on that kind of thing, that's exactly what this course will do for you. Here are the scanners again, just so you guys know. Again, here are the bonus sessions. So every Wednesday through, actually, we're gonna go through the end of September. We're gonna walk you guys through the market, and it's the 7-step process that we're gonna teach you, where we do live market scanning and idea generation. The process is sectors or broad market sectors, groups, stocks, and option selection. It's just a one-time payment, again, of $197. That's, you get lifetime access to the online material and the stock market scanner. Here is the stock market scanner. Again, it's 6 proprietary market scanners that include near-term bullish, near-term bearish stocks, intermediate-term bullish, bearish, and long-term bearish stocks, long-term bullish and bearish, and then of course the sector scans, which are really, really, really important. Here's what it looks like. Here's what the spreadsheet looks like. What I do is I post on the website, I post the scanners themselves, so you guys have real quick access to it without any delay. And so you'll stop fighting the market that way and stop guessing trends. And that's really the most important and most powerful thing that I can do for you. So again, it's an extensive video series. You get the stock market scanners, which are web-based, so there's no data required or no specific platform. It's on the website. We update it 3 times per week. It's behind the paywall, so you guys just have to sign up for this and you have access to it all the time. And again, of course, the summer bootcamp, which lasts all the way through the month of September. Okay, so we have 25 to go at this price. And let me show you guys just one more quick example to show you how this works. So one thing that we just did the other day, for examples, we had industrial stocks turn near-term bullish after having been and already being medium-term and long-term bullish. The industrial stocks last week turned near-term bullish, and they came up on our scanner, okay, here, and we also noticed some industrial stocks like Honeywell and so on showing up on our short-term bullish list. Again, they're already on the medium-term bullish and a long-term bullish list, and that gave us an idea to buy something like DuPont, okay, DD. And we did, and so far that stock is holding up pretty well. So again, it's that process, that top to bottom process that we want to make sure that we instill on you guys, so to make sure you can have an orderly process of looking at the market in any market environment. Yeah, okay, well, I think I'm gonna wrap it up here in just 1 second. Let me just take 1 or 2 more questions. Yep. Someone's asking if the bootcamp webinars will be recorded. Yes, the bootcamp webinars are absolutely recorded, and they will be sent out to you later on that day. Someone's saying if one of their main problems is finding reliable stocks to trade. Oh, that was the first one. Someone's saying that they find it hard to find the best trades and the best ideas out of all the stuff, all the data out there. Yeah, that's exactly what this is, because you need to gain perspective in order to be able to make money in the market. And by gaining perspective, by knowing what's moving up, what's moving down, where the money is flowing, allowing with the scanner and the course, you'll have a great leg up on the rest of the market by doing so and stop fighting the market.